right, so my name is Mike Wolf, I'm an economist with Wells Fargo. I'm going to sort of pull it back a little bit from what Jay presented and give sort of the economic view from 30,000 feet, focus a little bit more on the US, and then give a little bit of color about North Carolina and Raleigh, but a lot of it was already said, so we'll breeze through that a bit. So where are we in the US economy? I like to say that we're moving in the right direction, but we're just not moving there fast enough. So typically at this point in the business cycle, we would expect that real GDP would be about 3% year-on-year growth. But in 2013, we're forecasting 1.6% growth. So it's just over half of where we would like to be typically. So what are sort of the things that so this is real GDP, I'm sorry, so I should say that the shaded bars represent a recession. So what sort of impacts real GDP, total output in the US? And one of those things is real business fixed investment. So this is what businesses spend on structures, equipment, software. You can see during the worst of the recession, we had annualized losses of 25%. It's massive. Total output at the same time only declined 8%. So 3 times in real business fixed investment. Same sort of situation, bounced back in the recovery, beginning days of the recovery, and now we've sort of settled into this subdued growth. And so a couple of reasons why is, I think probably the main reason why is uncertainty. So the NFIB, the National Federation of Independent Businesses, conducts a study every month to create the survey, the Small Business Optimism Survey. And you can see small business optimism is low. It's consistent with the worst of the '91 recession. So also in this, so they create this index, but they also ask small businesses, what is your chief complaint? And so businesses have come back and they've named 3, or the top 3, which are taxes, government regulation, and poor sales. I should switch that. Government regulation was the number 1, then taxes, poor sales. So the good news in that is that poor sales was the number 1 chief complaint, and by a lot, that was everyone's chief complaint for small businesses. Let's drop to number 3. Also, I would argue that taxes are always going to be among the top 3 chief complaints for small businesses, right? Like no one's dying for April 15th to come along, and personally, businesses aren't such a fan of taxes. But the number 1 chief complaint, which is government regulation, I think is something very real and something that we are all too familiar with over the past few weeks with the government shutdown. So I think businesses need more clarity about what's going to happen. Will taxes be raised? Or are you going to get expenditure cuts? Where will those expenditure cuts come from? And so this happens. So this isn't just at the federal level, but this also happens at the state and the local level. And this is because basically all of these governments have these budget deficits. Not every government, but a number of governments have budget deficits. Don't have a real sustainable plan on how to get that down. And so cuts are looming. Taxes perhaps will have an increase in taxes. And so businesses don't really know what to do. They hold off on investment until they get a little more of a better picture. So that's just one element of why business investment is a little bit lower than we would expect. On the plus side though, on the graph on your left is the net percentage of banks that are tightening standards. So now fewer banks are actually tightening their standards on commercial and industrial loans. So credit is actually a little bit easier now to obtain for businesses. And this comes at a good time, so the graph on the right is demand for those commercial and industrial loans. So demand is actually up. So I personally thought this was surprising. I thought as demand increases, then banks would sort of actually make those credit conditions a little bit tighter. But as it turns out, American banks are in a much healthier position now than they were a year ago, certainly more than 3 or 4 years ago. And they're competing against one another. So we have all this Tier 1 capital on the balance sheet, and so now we're a lot more capable of making those loans. So that's actually good news for business investment. But I still think that this uncertainty environment is probably the leading sort of issue for businesses. So despite the fact that governments sort of have this ongoing problem of not really helping matters in the private sector, they do have one really positive economic benefit, and that is government purchases during the recession are actually up, right? So during a recession, when the private sector falls out, the public sector gets to step in and actually sort of help out the economy a little bit. So this was like the fiscal stimulus and a number of other different programs. Some of it's just cyclical, like more people go on unemployment, so you get more unemployment benefits, and automatically the government pays more. So that actually helps the economy a little bit. So you would expect that, when you have these big increases in government expenditures during a recession, of course there would be some cuts in the recovery as the economy sort of gets a little bit better. But the difference now is that we've just been spending and spending and spending. So you can see in a recession period, there was no real drop in government expenditures. And we're never, we forecast the end of 2015. We don't forecast government adding to the economy until well past the end of 2015. But normally you would think, right, so had we been had a budget that was sustainable, if we had sort of made the tough choices earlier on, we wouldn't be in this position. So government's perpetually going to be a net drag on the economy. Awesome. All right, so consumption. So again, same deal with consumption, what you and I and every other American does in the aggregate. Still subdued growth, a little bit better than overall GDP, but we're still only forecasting 1.9% for 2013, a little bit better than 2.2% in 2014. Just not where we want to be. For consumption, we typically think 3.5% at the 4 or 5 years out. All right, so what sort of affects consumption? The big thing is employment. So the graph on the left is the non-farm payroll number. We've had 180, 190,000 net new jobs every month. That's great news, right? The unemployment rate, the graph on your right, has come down from 10% to 7.2% now. Sorry, it just came out yesterday, so I haven't updated the graphs. But the problem is that fewer people are employed today than were employed at the end of 2007. And furthermore, the unemployment rate sort of overstates the health of the labor market. So there are things that maybe you've heard in the news that the labor force participation rate drops. So these are basically people who were looking for work and we call them discouraged workers. They can't find work, and then when the labor department goes and they survey them, they don't get counted as unemployed, so because they've stopped looking for work. So the unemployment rate looks a little bit rosier than it actually is. So we still have a long way to go in the labor market. The other sort of aspect of consumption that I want to point out is that wage and salary growth has been really, really low. And this is something that you would expect, right? That when there are all of these available workers, that you can't exactly go to your boss and demand a 10-20% increase per year, right? So, but we think it's going to, it is a really long time this has been so low. It's typically somewhere around 3%, and we're south of 2% for wage and salary growth. So fewer wage increases, a lot less money that we have in our wallets and our pocketbooks to spend. So it's sort of also just kind of, again, this subdued economic growth in the U.S. In between the recessions in 2005, when things were looking really, really great, and we thought none of that would sort of come to an end, we took on a lot of debt, right? So you see this on the graph on the left, is U.S. household debt relative to our income. It's a massive increase. So we had 125%. Debt was 125% of what our actual income was. Yes?
Is that unsecured debt or county secured as well?
Yeah, it's all debt. Yeah, so it's like mortgages, student loans, auto loans. It's mostly mortgages, but student loans, auto loans, credit cards, anything you name it. So this big swell, and so what's sort of subduing consumption now is that we're still paying off those debts, right? So we bought houses we couldn't afford, we bought cars we couldn't afford. So we're basically essentially still kind of consuming what we consumed back in 06 or 05, which is unfortunate. But the good news is that actually, you know, on the graph on the right, the household debt service ratio is, this is how much we spend every month to pay down the principal and the interest payments on our debt, and again, relative to income. It's come down to historically low levels. So this is because mortgage rates plummeted, everyone just went in and refied the mortgage. And so now we actually owe a lot less every month. So we think this is, you know, we've sort of hit an inflection point here that that consumption, you know, the people's finances are a little bit better off, that they'll actually be in a better position moving forward to sort of lift their consumption now that they've gotten such favorable rates. All right, so this is, so we're gonna switch a little bit to the Fed balance sheet and talk a little bit about housing at the national level. All right, so this is what quantitative easing looks like. So before the recession hit, the Fed had about $800 billion on their balance sheet worth of assets. And it's gone up over $3.5 trillion. Right? So more than the Fed is more than quadrupled what it holds on its balance sheet. So most of this is treasuries, and then a lot is mortgage-backed securities, and then you got a little bit of other stuff mixed in there. I'm not going to bore you with the details of this. We can talk about it in Q&A if you have some burning questions. I think it's actually kind of terrible and boring, but the thing that I really want to point out is that by purchasing all of these treasuries and all of these different assets, it raises the prices of those assets, specifically financial assets. And so this has one very clear effect, and it increases household wealth. So this sort of burnt orange piece of household wealth are financial assets, and so they've reached their pre-recession peak. So that seems like really good news, and it is for those people, but why is consumer confidence still so low? So we think the reason that this is because, I mean, aside from the fact that we still have all this unemployment, but is that not that many people actually own financial assets. So the top 10% of households own almost 90% of the financial assets in the US. So that's a pretty staggering number. This isn't because, the Fed doesn't do quantitative easing and all this monetary policy just to affect people who are at the top, but it's just that they only have a limited sort of toolbox, right? And so this is just sort of, it only affects those people. Yeah, a lot of people do own some financial assets. Most people have like a 401k or some sort of retirement account that gets impacted, but it's just the level of impact isn't so great for them. But the other piece is, so the mortgage-backed securities that the Fed buys, right, so that actually lowers the mortgage rates and fuels demand for mortgages, fuels demand for housing, and has boosted home prices. So this has actually had a much broader effect on the US economy. And it's also the reason why mortgage rates spiked in June, or May or June, I forget. So everyone is really keen on, when does the Fed taper, and what do they taper? So currently they buy $85 billion worth of assets every month. Half of those are mortgage-backed securities, the other half of them are treasuries. So the reason that matters is that if they stop buying mortgage-backed securities, it means that your mortgage rates essentially will spike again. So mortgage rates I think are actually like priced in a little bit that that they are going to taper some of the mortgage-backed securities in the near future. So I think some of that's already priced in, which is the good news. But it remains to be seen. The Fed hasn't provided a whole lot of guidance about what they're going to do in that vein. So for the national housing market, what I want to say is that it really does actually lead the recovery a bit. House prices are up about 12% year on year. And what Jay spoke about a little bit about with how housing construction actually leads to, I think his rule of thumb is like three jobs or something for each house. I think locally it doesn't necessarily lead to a big expansion, but nationally it actually does lead to a huge economic expansion. So typically when you think of housing construction, you just think of like the construction workers. But it has a much broader effect than that, right? So it's everything that flows into housing construction. So it's the lumber, you buy carpets or flooring, you buy appliances, you have to wire the house, whatever it is. And a lot of that comes from the US, right? So carpeting, the carpet capital of the world, is in Dalton, Georgia. Whirlpool still makes a lot of its appliances in Michigan. All the copper wiring, where largest deposits of copper, right? So these all fuel US jobs. And I really can't overstate how much increased housing construction actually really does fuel an economic recovery. The bad news, right, is that housing starts are still really low, right? So this is annualized data, so the last real data that I have here is for 2012. I think our 2013 forecast is probably pretty spot on. We're getting pretty close to the end of the year. But those are still like historically low levels since 1980, where I have this graph down. And so we really have a long way to go, and I think that this is, while this is a leader of the recovery, we're just not going to get there as fast as we would like, right? All right, so let's just talk briefly about North Carolina and Raleigh, since a lot of it was already covered. Fortunately, I actually don't disagree with anything that Jay said, which sometimes happens in these presentations. So North Carolina actually got hit really hard during the recession, much harder than the U.S. as a whole. And so I think that actually explains, get some notes here, because I get some statistics, but so I think that explains why North Carolina still is struggling. The U.S. I think is only like total employment is only 1.3% from its pre-recession peak, but we're here right about 3% from its pre-recession peak in North Carolina. So definitely a laggard in the recovery nationally, and you can see that the unemployment rate is still up at 8.7% in August. So no, definitely not good, right? I mean, in the U.S., 7.2%. That's a pretty far differential. And so in the graph on the left, we have North Carolina total employment, and it looks, and this is, I think, Riley drives part of this, but right in the sort of 2012 area, we had employment growth over 2%, but it's really come down quite a bit. So right now we're only at 1.7%. It's for year-over-year growth. So that's about average, but just not really where it needs to be, particularly since North Carolina is actually a laggard. You would think that typically the worst performing economies in the recession get like a nice bounce back in the recovery, and North Carolina just isn't really getting that. A couple of the industries that have been doing well are professional business services and financial activities. Financial activities was pretty slow to take off, and is actually now sort of booming back again where I am, particularly in Charlotte. Professional business services, a lot of that's here, right? This is SaaS and IBM, they fall into that. Also like lawyers, architects, all of those sorts of people fall in there. A lot of that growth is a little bit stronger, and that's died down a little bit. We'll talk about that in a second. And then manufacturing actually is in positive territory, which is a lot better than we can say for a number of parts of the country where it's actually still falling. Not hugely in positive territory, but still okay. And then government remains one of the big laggards, and this is pervasive across the U.S. These are unemployment rates. Unfortunately, this is July because the government shut down countywide, or by county. Unemployment rate just wasn't available until yesterday for August, and probably won't be available until who knows for September. But so you can see Raleigh, right? The Raleigh-Cary area actually doing okay. A tiny piece of Charlotte doing okay. A little bit worse in Greensboro. Asheville has a number of counties that are actually also at the low end of the range. And then Wilmington, also a laggard there at the bottom right. Hopefully you know your North Carolina geography. The light colored ones are Raleigh, Charlotte at the bottom, Asheville at the left.
Raleigh.
Raleigh. Sorry, I grew up in the Northeast.
Ain't their name money.
I know it. So across the North Carolina, so we have Wilmington, that looks like it's doing really good. So year-over-year gains on the horizontal are pretty strong, but Wilmington had basically no growth until this year. So they're coming from a pretty low point. Charlotte's actually doing okay, so finance is bouncing back finally, so that gives a big boon to Charlotte. And then Greensboro has been sort of a laggard, but improving a little bit. Asheville has come down a little bit, but actually Asheville has been pretty strong during the recovery. They've had a lot of manufacturing come back to that area, and then also some leisure hospitality. All right, so let's talk. You make me so self-conscious about saying Raleigh. So we'll talk about Raleigh in a minute, but the house prices in North Carolina. So you can see on the left, North Carolina's, so this is the CoreLogic's house price index, did not nearly have the giant boom that the US had. And it's actually, so that's such a huge benefit to the state. And it's the same thing here. Right, so not just so those people who have their mortgages underwater can't move and like the implications for the housing market, but also that if your mortgage is underwater, if you owe more on it than your house is actually worth, then you're much less likely to go out and buy other things, right? Like you feel a little panicked, and probably rightfully so. So that's actually been a real positive for North Carolina's economy, that people are still actually able to consume more than in other parts of the U.S., just based on housing alone. And then for construction on the right, single-family market is still pretty low, but actually the multifamily market has picked up quite a bit. All right, we'll skip that, it's fine. All right, so like I said before, so Raleigh had this big boom in employment. We had 4% year-over-year gains in employment by mid-2012, and it's really slid in 2013. So we're only at 0.8% year-over-year gains. Fortunately for the metro, the unemployment rates actually below the U.S. unemployment rate, so 7.2%. In July, and I think the numbers just came out again, so I think it's actually at 7.1% for August. So Raleigh was actually just at a better situation in general, and I think rightfully so, right? So I don't know if people know this, but all of these other, so I cover metros and states all across the U.S., and every time you read something from like an economic development commission, they're always trying to mimic you guys, right? So it's always like, oh, let's have an innovation hub, we'll be the new RTP, like, and to make success often not such good success. So because they're missing some key components, right? So they're missing like a Duke and a Chapel Hill, and they're missing, right? Like, it'll be like some school you never heard of, and they'll be like, oh, like this school will lift us all out, poverty. And it doesn't inspire investment. Not to be mean. And so a lot of this deceleration has come from the professional and business services part of the economy. So these are the SaaSes and the IBMs, but they're still in growth territory, right? So it's not growing that much, but they had these massive gains. I think it was like 7% year on year in 2012. So you just can't sustain that, and it's inevitable that growth is going to sort of temper a bit. Some other pieces that I want to just sort of point out about the economy. The one is government is remarkably still up just slightly, though state government employment is still dwindling down. I think they lost a couple thousand since the recession, and it still looks like it's heading south. But the one big surprise actually is manufacturing, right? So we talked about this a little bit. Manufacturing everywhere else is still in decline, but for Raleigh, it's up 5.6% year over year. That's huge for any industry, and it's massive for manufacturing. What's nice about manufacturing, there's always like mix. Depends what kind of manufacturing if it is for how good the job is. And here you guys have really good manufacturing. Right? So you have like chemical manufacturing, like you guys have like the hot tech ones, and the high paying ones. So I think this is actually a sort of a place of strength for you guys. And another piece that I want to mention, about manufacturing is that although North Carolina's had all of this sort of this decay in the textile industry, there are all of these other businesses are cropping up to sort of bring it back. Not necessarily in the manufacturing space, but in the technology space. So there are all these startups here. I was at a conference a week ago, actually in DC, but everyone was from here. about, I think they just wanted to go to DC. I think it was like they were like, we need a trip. And it was, I don't know, whatever. So there are all these technology companies that are coming back to serve textile manufacturers. So instead of, it won't be, instead of like, the textile manufacturers that are coming back to the US aren't labor intensive because labor is more expensive here. But the way they're getting them to come back is implementing all this technology, and all the technology is actually being developed here. So it's like fun stuff like the scanners. Like if you go into like you go into a department store and get your body scanned, and they like fit you and stuff. This was one guy I spoke to, and then the other ones are actually just like making the clothes without having an actual sewer. So manufacturing is actually is doing well, and those things are manufactured. It's changing, it's evolving. And again, so I'm not going to tell you guys about your own housing market, but I just wanted to highlight the implication that, same as in the state, that house prices didn't have the big boom and bust that they had, like they did in the US, and that also multifamily construction is up in a massive way. That's the red line on the graph on the right. And then finally, the one big thing about, I think, that keeps sort of businesses interested and keeps sort of growth moving in the right direction here, is one, population growth is double what it is in the US, and it's considerably more than it is in North Carolina. And then also educational attainment. It's one of the highest, so this is percent of the population with a bachelor's degree. This is one of the highest in the US. And businesses keep saying how they can't find the skills that they need where they are. So this actually sort of helps encourage businesses to come to North Carolina and come to Raleigh to sort of find those skills. And I think that's really all that I have. If you guys want to ask any questions, I'm happy to talk about that now. Here's our forecast. No time.
But we'll have questions now.
Okay. Perfect.
So again, thank